In this video, as well as the next couple of recordings, we're going to talk about fixed income cash flows and types of cash flows. We're going to start off in this video by exploring how the principal of a bond gets amortized. We'll start off with the most basic type of bond that gets issued in terms of its principal repayment schedule, and that is what we call a bullet bond. So let me write the name down, bullet bond. Now, whenever you see this name, you should associate it with a sort of classic bond. This is very typical for government bonds, as well as the vast majority of corporate bonds. So what they do is they will make a periodic coupon payment as we coupon payments as we previously drew in our recordings, in our sessions, and then at the very end of the bond's life, at the maturity date, you're going to have the principal repayment 100% being repaid at maturity. So 100% of the face value, the par value, or principal is repaid on the maturity date. And actually, further on in the curriculum, whenever we typically deal with bond computations, when we do yield computations, when we do price computations, we most of the time assume that we're dealing with a bond that is of a bullet nature, as that is this kind of the standard for corporate as well as the vast majority of government bonds as well. However, so we'll have plenty of opportunities to see how these types of things function. However, more interestingly, from the perspective of this video and this topic, we should look into what's called amortizing debt. Now, I'm using the term debt because your curriculum uses it, but to be honest, this term is more universal than just bonds, because it applies not just to debt securities, but also any form of debt relationships, including loans taken out from a bank, which typically are of an amortizing nature. So what's going to happen here is that at least a portion of the principal, I'm not saying kind of 100%, but at least a portion of that principal is repaid by the issuer prior to the maturity date. And this may take place, so this may happen in a number of ways. The idea is that the principal repayment is in some shape or form spread over the life of the debt relationship. As I said, this is what typically happens if you, for example, take out a loan from a bank. The bank's not going to allow you to pay the principal off at the very end of the bond's life, which would suggest the loan's life, which would suggest a bullet type structure, but it's going to force you to make typically monthly payments, which include a repayment of principal, and on top of that, interest as well. Now, if you were to contrast a bullet bond with an amortizing debt structure, which could be a bond, you should be able to draw certain conclusions. For example, bonds of an amortizing nature will have or be associated with lower credit risk, because you, as an investor, are recovering the principal earlier on. The repayments are spread over the life of the instrument. There is less still outstanding, which leaves you with less risk of what will happen if the issuer fails to repay. So this is lower credit risk, obviously, as compared to a bullet bond, but at the same time, so let me write "but" with exclamation mark, because this is going to be a negative feature here, a higher level of so-called reinvestment risk, because you are receiving bigger cash flows due to the principal repayments which happen over the life of the bond in an amortizing structure. Those will ideally need to be reinvested, at least in a sort of institutional setting. You'll want to reinvest these in the markets. And you face the risk of, well, what is going to be the reinvestment rate, the rate of interest at which I'll be able to reinvest those cash flows? And obviously the risk is it may be lower. So receiving money earlier here opens up the risk of having to reinvest these at potentially lower rates. Right, okay, because we've got more funds to reinvest. When it comes to these amortizing structures, your curriculum contains examples of computations, which we're going to practice in just a moment using exam-style questions. But let me just write that this amortization can come in various types. I'll show you two now, then we'll do some questions, and after that I'll show you even more. So let me write out the initial sort of two types. Fully amortizing debt. And I want you to get used to this phrase, fully amortizing debt, as opposed to partially amortizing debt. And we'll practice both in just a moment. So partially amortizing debt. Now, if you're told that a bond, for example, is structured in such a way that it's a fully amortizing bond, which I'll show you in a question in just a moment, what that's going to imply is that the bond will feature uniform or sort of level, that means equal in size, right? Level payments all the way until maturity. And each one of these payments, right, that the bond makes will include, each one of these includes a portion of interest and a portion of principal. And whilst the actual level of the payments, be they quarterly, semi-annual, annual, or I don't know, monthly, which we'll also see with a mortgage loan, even though these are equal, the proportions between the interest and principal components in each payment change over time. Initially, there's a lot of interest that we're paying and less principal, or I mean, let's not say whether it's less. Let's say that the amount of interest you're paying systematically drops, whereas the amount of principal you're repaying systematically rises, which we'll be able to see in just a moment. Okay, so the proportions change. Now, with partially amortizing debt, what's going to happen is that a portion of the principal is going to be repaid over time. Typically, in once again in a very sort of scheduled way. It's not going to be erratic. It's going to be scheduled, and I'll show you questions on that as well. Is repaid over time, but there will still be a remaining sum left, like a lump sum that has to be repaid at the very end. So, and remainder, a kind of lump sum, a big amount, different in size to the previous repayments, plus remainder repaid at maturity. Now, don't be surprised to see that this payment, which is left until the maturity date, is called a balloon payment. So some very specific phrases to accommodate here, like bullet, balloon, fully amortizing, partially amortizing debt. Very important concepts. And what is more, your examiner expects you to be able to perform computations in the exam concerning these, because there are examples in the book, in the curriculum. So let's get cracking with those examples. I'm going to wipe the screen now, my board, to make space for some serious computations. So let's get cracking with those questions. This first one is quite challenging. In the end, it's quite easy to compute, but there's a lot of things to think about, and you have to get the operations on your calculator quite right. However, even though I don't really expect the examiner to give you such a question, you never know. It's in the curriculum. There is an example on this. There are even questions on specific box item sets on this in the curriculum. So, as I say, it's better to be prepared. Okay, this is it. The amount of principal received by investors in respect of the second semi-annual period on a fully amortizing 5-year, 2.85% semi-annual coupon bond with a par value of 100 million euro is closest to, and 3 options follow. So, the important thing is that this is a fully amortizing bond. Fully amortizing, and you already know what that means, or at least you should know. That means it's going to make level payments over the course of its life, without any big lump sum payment at the end. When the maturity date comes, you're going to receive this, as an investor, the same amount as you would have received before, every period or every payment date. In this case, it's a 5-year bond. So it's going to feature 10 semi-annual payments. The interest rate provided, or the coupon rate, is 2.85, but as you should know by now, every time we're given coupon rates, they are stated in annual terms. We need to, in order to make to calculate the size of a single coupon payment, that needs to be kind of scaled down by dividing, in this case, by the payment frequency of 2. However, that's not really so relevant. We're asked for not the coupon payment, we're asked for the size of the principal payment, or the amount of principal which investors will receive as part of the second payment that happens, I guess, at the end of the first year. The first payment happens at the end of the half year, and then the second at the end of the first year. The first thing to do here is actually to compute the size of the level payments. And this is very difficult to do unless you use your calculator in a clever way. So I'm assuming you've already had an opportunity to watch some of the time value of money videos on the channel in the course. If you haven't, I'll include the link to the playlist featuring all the time value of money videos, which are on the Let Me Explain channel. However, we're fully going to utilize what your calculator can do as part of the time value of money worksheet by plugging in the relevant numbers into the relevant places. So in terms of the input for n, the number of periods, I'm going to have 10. 10 because we've got 5 years, and each year we're going to have 2 payments. So 10 is going to be our input for n in the time value of money worksheet. So I'm doing on my calculator 10. Actually, before I do anything, let's clear the time value of money worksheet. That's always good practice. So press second followed by the ever V key, which has clear time value of money, CLR TVM as its secondary function. Now input 10 followed by n. Your calculator now understands this is the input for the number of periods. Next, I want to tell the calculator what the rate of interest is. So this is going to be 2.85, but it has to be expressed on a per period basis. And because here we've got 10 semi-annual periods, I need to divide this by 2. So 10.85 divided by 2, that obviously equals 1.425. And I'm going to tell the calculator this is my input for I over Y, which is the interest rate. Okay, next we go to PV. Obviously, we don't have to work in this order. Actually, I don't have to go from left to right. I can input anything. I could do FV if I wanted to, because this is a fully amortizing bond. By the time the last payment was made, we're going to have the bond fully paid off, or the principal fully repaid. So let me tell the calculator that 0 will be my input for FV. 0 FV. Actually, if I left it blank, assuming I had previously cleared the time value of money worksheet, it would have been 0 anyway. And now let's tell the calculator that the input for PV is going to be the present value is going to be 100 million. But as many of you will know, crucially with a negative sign, because you have to have opposite signs for example, for the PV, FV, and PMTs. Actually, if I made this positive PV, that would mean my computation of PMT would have been negative. I prefer to have a positive PMT, so I typically make PV negative, but that's a question of choice, really. Things will work anyway with a 0 FV. PV now, do CPT PMT to compute the periodic payment. So CPT in the left-hand upper corner of the calculator keys, CPT followed by PMT, and my calculator is showing me that PMT is 10.800. So that basically means we're looking at 10.8 million euros as our semi-annual payment from issuer to investors on this fully amortizing bond. This is what's required to get the bond principal down to 0, and in the meantime also pay interest at the suggested 2.85 rate. Okay, we're not asked for the payment, we're asked for the amount of principal contained in the second payment. Now, there are quicker and slower ways to do this computation. I'm going to show you the slower one, and then you'll see how you can do this really, really quickly if faced with such a question on the exam. So what I'll do is I'll write out like a schedule for this bond or for this loan. So I'm going to have years over here, and I'm going to have year 0.5. So that's the 6 months following the issuance date. And then I'm going to have year 1.0, so first year. And actually, that's as far as I'll go. I don't want to go any further. And I know from this computation that we've just done that there is a payment which happens on each of these kind of dates equal to 10.8 million euros. That's from over here, isn't it? Okay. However, the question is, how can that be split into the two relevant components, namely interest and principal? And if you're doing this the long way, it's always a good idea to start with interest and then compute principal. Just makes more logical sense. So this payment is composed of two things, interest and principal. Not in constant proportions. You'd have to calculate the amount of interest and principal contained in each payment date by date. The way to do the interest computation is to take the amount of principal still outstanding and multiply by the relevant rate of interest. So to perform this computation, what I would start off with is the principal on the bond, 100 million, which until now has not been, this first payment has not been repaid at all. So 100 euros million multiply this by the relevant rate of interest, 2.85%, but halve it to make it, to make it in line with the fact that we're paying interest for a semi-annual period, and you're going to get, let's see, well, 100 times 0.0285, that's 2.85% divided by 2, that's going to give me, wait, something was wrong here, probably 100 times 0.0285, but divided by 2, let's have a look, yeah, that's better, 1.425. That's going to be the amount, this is in million, 1.425 million euros of interest. And because the entire payment that happens at the end of the first 6 months is 10.8, the principal is computed as a residual value. You go, well, let's take 10.8, deduct the amount of interest being paid, and that will give you how much principal gets repaid with the first payment. So negative 1.425 at 10.8. Okay, 9.375. And as you can see, that's one of the answers to the question. However, it's not the correct one, because this is the answer to a different question: how much principal gets repaid in respect of the first semi-annual period. We're asked for the second. So the thing now is to compute how much principal is still outstanding. How much still remains outstanding or to be repaid. And for that, you have to take the initial amount, 100, and deduct the amount of this repayment. So once again, I'm going to turn this into a negative figure, add 100. Okay, and we get 90.625. Good. And we can now use this knowledge to solve the second row, because over here, we can compute the amount of interest that gets repaid or paid. Interest is not repaid, it just gets paid. So I'm going to take the same interest rate, 2.85% divided by 2, but this time, instead of multiplying by 100 million, which was the initial amount of principal in the bond, in respect of the second period, I'm going to use the amount of principal outstanding as at the end of the first period, so 90.625. The message is you only pay interest on what still remains, on the principal that still remains unpaid. So 90.625 times 0.0285 divided by 2, let's see, 1.291 roughly. Okay, 1.291. So the amount of principal follows the same logic, or that computation follows the same logic. Because the payment made by the issuer to investors is a level payment, this will still start off with 10.8, but I'm now going to deduct the 1.291. As you can see, even though the size of the payment made by the issuer is constant, it's level, the proportions between the interest and the principal are going to change. We're going to have less interest as time goes by, but more principal repayments. So 10.8 minus 1.291, that gives 9.509. Okay, good. As you can see, this is in line with answer C, so that's the answer to the question. It took us a pretty long time to do this, didn't it? So there is a quicker way, let me show you. What I would do in the exam, if faced with such a problem, is I wouldn't bother with all of this. What I would actually do is compute quite easily on the calculator the amount of principal outstanding over here, the amount of principal outstanding over here, and compute the answer, or get to the answer as a difference between the two numbers. How would I do this? Well, over here, I mapped out the whole path, the whole schedule of inputs needed to compute the level payments. those inputs are still stored in your time value of money worksheet. What you can do is do a recomputation with fresh inputs. For example, I could ask the calculator to compute for me the PV, the present value of the bond or the principal outstanding, if I just adjust the number of periods from the initial 10 down to 9. Look, if I now press 9 on my calculator, follow this up with n, so to tell the calculator, well, what's going to be the situation if there are still 9 payments left, and now get it to compute the PV, CPT PV. You're going to see an answer of 90.625, I guess, if you round it up, which is exactly the same as over here. How do I get this number? Well, do 8n, so change that single input and recompute for PV. And I see 81,116 roughly. Okay, and let's see if doing this minus this gives us the right result. 90.625 minus 81.116, 9.509. Absolutely right. Much easier, much quicker than doing it the long way. And actually, once you know the principal outstanding at any moment in time, this could be after 2.5 years or after 4 years. The only thing you need to then compute is how many payments are still left, and that's how you get to the principal outstanding at any point in time. You can not only compute the principal repayments, but you can also easily compute the interest payments at any point in time, because you take this as the opening figure for the next period and multiply by that constant 2.85 divided by 2, whatever other rate. This technique comes in very handy, not only in the fixed income section, but also, for example, when you get to financial statements analysis and you have to compute what's known as the amortized cost of a bond or of a lease liability, a bond investment, a bond issue, a bond liability or a lease liability, any kind of debt liability or investment which amortizes. Okay, let's have a look at the second question, this time with partially amortizing debt. The level of semi-annual cash flow received by investors for the first 4.5 years in respect of a partially amortizing 5-year 2.85 semi-annual coupon bond with a par value of 100 million and a balloon payment of 50 million is closest to. Okay. Similar data to what we saw before in the previous question with some subtle, nevertheless very important changes. So if you draw this out on a timeline, what's going to happen is for the first initial 4.5 years, 4.5 years, this bond, I'm assuming, is going to make a certain level cash flow to investors, right? And on the maturity date over here, that cash flow is going to be much bigger because it will include a balloon payment. But before we even consider that balloon payment, there's going to be that final level payment in line with all the previous ones, plus the balloon payment on top. So over here on the maturity date plus the balloon payment. And we know how much that balloon payment is going to be. It's equal to 50 million euro. So that obviously throws the final cash flow out of scale here, and we're not dealing with this one. We are, however, interested, or we are asked for the size of these cash flows over here, which get repeated, across the 4.5 years, the initial 4.5 years of the bond's life. How do you do this computation? Well, once again, it would be extremely difficult on a calculator, but it's on paper without the calculator. But it's really easy if you can use your cash flow worksheet on the calculator in a clever way. So once again, let me take the calculator into my hand on my phone, which has a calculator app, Texas Instruments calculator up. And what I'm going to do is I'll provide you with the inputs, but hopefully you'll get the you can see where the logic comes from. Once again, I'm going to tell the calculator that the input for n is 10 periods, 10 followed by n. And actually, let me just clear the calculator again. Second followed by the FV key. So 10 followed by n. Now, you may think, why isn't he doing this for 9 periods only? Well, the final payment, the final cash flow, includes an element of these equal payments. So, in fact, there are 10 periods here where it happens. The 50 million is on top of this. And in order for your calculator, in order for this computation to work, we need to tell the calculator there are 10 such payments, including this final one. But that final one is increased, it's enhanced by a balloon payment, which we know is 50 million. So 10 for n. Then for I over y, I will once again make this 2.85 divided by 2. And I know that's 1.425 already. So 2.85 divided by 2. Follow this by I over y. Okay. Now, PV, just as before, I'm making this a negative 100 for PV. And when I make my PV input negative, that means I have to make the FV input positive 50. So this actually becomes my FV, the amount that still will have to be repaid at the maturity date. You can't provide both numbers with the same sign. Your calculator will kind of freak out, will not be able to perform this computation properly. And for reasons which are explained on the time value of money playlist. So I do encourage you to watch that if you haven't already. So now it's a question of computing for PMT, CPT, PMT. And we are presented with an answer that equals 6.11, which is very nicely in line with option A over here. Nice and simple. Okay, and for the final question in this video, I'm going to actually reuse a question that's already been featured on the Let Me Explain YouTube channel, which concerns payments on a mortgage loan. Why? Because for some reason, your examiner included, or the authors of the curriculum included such an example, very similar example to this one, in this section of the curriculum. So mortgage loans are often used in the context of ABSs, asset-backed securities, more specifically mortgage-backed securities, and you need to understand and be able to compute what happens on a mortgage loan in order to appreciate what happens to an MBS, a mortgage-backed security. Hence, I guess, this requirement. So it's a simple question. A client is planning to buy a $200,000 house. If the funds for the purchase are borrowed with a 6% 30-year fixed-rate mortgage, the monthly mortgage payment is closest to. Whenever you see mortgage loans, there is a simple assumption that you need to make. You've got to assume these are fully amortizing loans. Assume fully amortizing loan. Actually, with this data, you can't make any other assumption, to be honest. A mortgage loan is never going to be a bullet type of structure. It's going to be amortizing. So very simple. It's just a question of providing the right inputs to the calculator. So for n, and I'm not going to bother saying something input n. I'm just going to say you have to make n equal to whatever is the number of periods. Here we're making monthly payments on the loan, so 30 years multiplied by 12 months every year, that's going to give 360 for n, the number of periods. The rate I over y is going to be based on the 6%, but that has to be scaled to a monthly basis as well. So that's going to be 6 divided by 12, which actually is 0.5. What else? For PV, I'm going to have minus 200,000. Because it's fully amortizing, my ever V input is going to be 0. Now you can either do 0, you can do ever V set at 0, or you can just leave ever V blank, assuming you've cleared the TVM worksheet from the previous question. And we're going to be looking for CPT, so computing CPT. Not CPT, PMT. CPT is the shortcut for computation, okay, to compute. Okay, my calculator in hand. Clear the TVM worksheet by pressing second followed by FV. So I'm going to resist the temptation to provide anything for FV because I trust that the calculator makes the 0. 360 n 0.5 I over y, 200,000 negative for PV, and compute for PMT. Okay, and 1,199 point something seems to be the answer. If I had made PV positive, this would have come in negative. That's the logic. Anyway, it's answer C. Okay, let's press ahead with the topic of amortizing debt. We've seen, well, we started off with bullet bonds, which don't amortize their principal. Then we switched to amortizing with the fully amortizing and partially amortizing options. And I just want to show you 2 additional structures, but we're still under the amortizing debt structures. So this is still continued. And just 2 left, as I said, sinking fund and a waterfall. I'll write the second name down in just a moment. So a sinking fund, no computations needed here. I just want you to be ready for potentially a theoretical question on this topic. If you see this term in a question, what it means is that the issuer sets aside, kind of as a reserve, funds, and these funds get paid into an escrow account. So that's an account from which the issuer cannot draw the money and use it for other purposes, like to cover operational expenses. So this is money especially set aside in a separate bank account from which it cannot be used for anything other than to repay the bond principal early. Now, this setting aside of the money, it's not a one-time thing. It happens over time, so it's spread over time. But the thing is, the money is going to be used to repay the bond principal early. That's what's meant by a sinking fund provision or a sinking fund structure. There are 2 ways which your curriculum discusses of this being done. So this could be done to randomly selected investors. So certain investors get their principal back early, others don't. They have to wait until the official maturity date, which can be a good or a bad thing depending on what's happening to interest rates as compared to the coupon payments they are receiving on the bond. So to randomly selected investors, that's one way. Or another way is to do this under a specific sort of contingent provision called a call option, which we'll discuss in a moment. Under a call option, which basically means that the issuer can repurchase the bonds from the holders at a specific pre-agreed fixed price, typically close to the principal value. Okay, these two methods may be tested, but even if they appear, it will only appear in a theoretical question, and I guess they'll probably ask you, if at all, about what a sinking fund generally is. Now, one thing to maybe appreciate additionally here is that having a sinking fund reduces, and this is the case with any amortizing structure, to be honest, this reduces credit risk because you're getting as an investor, you're getting the money earlier. You don't have to wait so long. So the risk that you'll lose and you will not be repaid goes down over time. But it does enhance, or it does increase the thing we already mentioned, reinvestment risk. Let me just stress that this is not unique for a sinking fund. It's actually the case with any amortizing debt structure. Increases reinvestment risk. The earlier you receive, the more money you receive early, the more you have to potentially reinvest at an unknown interest rate. That's the point. Okay, sinking fund, that's it. The second thing is a waterfall, but this actually is something that I already kind of covered in a previous video when I discussed the sources of repayments on bonds, especially on asset-backed securities and mortgage-backed securities. So very often with asset-backed securities, especially mortgage-backed securities, you're going to have a waterfall structure where investors holding specific classes of bonds, known as tranches or grouped in tranches, will receive money earlier or later. So a waterfall is kind of the name given to the structure that determines the priority or the timing of principal repayments to the various investors. Once again, it's a way of giving money earlier to some, giving money later to others. So different amortization schedules. These investors have, so investors with different priority of claims. And because the cash flows, which are used to repay principal to investors under the waterfall structure, typically come from mortgage loans. So every mortgage loan, like we saw in the question before, every month borrowers make a payment or repayment, and that includes a portion of interest and a portion of principal. And now it's a question of how do you distribute that principal to the investors holding mortgage-backed securities. If it happens under a waterfall structure, what will happen is the principal will first be paid or used to repay those investors who hold the highest tranches or bonds belonging to the highest tranche, the highest class of security issued under the waterfall. And only once they've been repaid, the money goes to tranche B investors. And then, in the third order to tranche C investors. So signing up for a specific tranche gives you access to earlier or later receipt of principal repayments. However, what is quite important is, irrespective of whether you sign up for this senior tranche, let's say, or a more junior one, all of them, all the investors, all classes, receive current interest. Obviously, they receive current interest until they've been fully repaid, because once your principal has been repaid, you no longer continue receiving interest. You only get interest on the principal, which still remains unpaid. Tranche A investors face the lowest level of credit risk. Tranche C investors, including, but also the ones lower down, this absolutely is not limited to the letter C. I've just run out of space here. But you could go all the way down to something like Z. There is, in fact, something like a tranche Z or tranche Z, tranche as a tranche Z as well. However, the point is, these top investors who buy into the senior tranche, they face the lowest level of credit risk because they receive the payments first. Those who sign up for the lower tranches or bonds belonging to those tranches face the highest level of credit risk. Okay, that's enough for this video. In the next one, we're going to revisit the topic of floating or variable interest securities, still continuing with the theme of fixed income cash flows and types.